Our previous discussion explored the intricate financial landscape of Air Industries Group. Today, we're shifting our analytical focus to Nauticus Robotics, Inc., ticker KITT. This is a company pioneering fully electric, autonomous robotic solutions for, well, pretty vital subsea applications. The central question we're grappling with is this: can Nauticus Robotics' significant operational advancements and strategic partnerships truly outweigh its deeply concerning financial performance and, frankly, unproven business predictability for long-term viability? I'll be presenting a perspective emphasizing the company's strategic growth and technological innovation, arguing that the future potential here is significant.
And I'll be taking a hard look at the financial sustainability and, let's face it, the inherent risks. I think the numbers tell a much more sobering story about its path forward.
Excellent. So Nauticus Robotics, it operates in a highly innovative and, I think we can agree, increasingly crucial sector. They're not just building robots. They're developing these comprehensive robotic systems for service, selling the advanced vehicles and components, and also licensing related software to both commercial and defense sectors. Now, while their current financial metrics certainly present a significant challenge, I firmly believe these figures have to be understood within the context of a pioneering technology company, one making substantial foundational investments for future market leadership. This isn't a mature industry. It's being built right now. The company has demonstrated a pretty remarkable technological progress. We've seen the Aquanaut Mark II reaching impressive ultra-deep water depths. A second Aquanaut vehicle is now moving into acceptance testing, signaling, readiness for deployment. Their AI-enhanced mine countermeasure vehicle has undergone successful live testing, and they've even announced the splashdown of next-generation Aquanauts. These are critical milestones for any deep tech company. And from a strategic standpoint, Nauticus has been incredibly proactive in building its market position. They completed the acquisition of SeaTrepid International back in March 2025.
Okay.
Which immediately expands their service capabilities and market reach. They've also forged key alliances with Leidos in January 2025, Advanced Ocean Systems in July 2025, and Open Ocean Robotics in June 2025. These aren't just names dropped in a press release. These are strategic players that I think validate Nauticus's technology and open doors to new segments. And crucially, they've secured significant customer engagements: an Aquanaut Mark II evaluation agreement with a global supermajor oil and gas customer in December 2024, completion of Gulf of Mexico field survey work for Shell in November 2024, an offshore service agreement also with Shell in September 2023, and a contract with Petrobras in June 2023 to develop and test the Aquanaut AUV in Brazil. They've also regained compliance with NASDAQ listing standards in February 2025 and secured crucial funding, $12 million in February 2024, and additional capital in January 2024, alongside appointing new management. And finally, a patent for a subsea manipulator from January 2023 clearly underscores their tangible intellectual property. To me, these strategic moves, these technological breakthroughs, they are unequivocally laying the groundwork for substantial future growth in a critical and expanding industry.
Those are certainly compelling points regarding the technology and the partnerships. I grant you that. But I come at this from a fundamentally different perspective when I look at the cold, hard financial data. It reveals a company in severe distress, grappling with what appear to be, fundamental business model challenges. Its profitability metrics are, frankly, alarmingly negative across the board. For the quarter ending June 2025, the gross margin percentage was a deeply negative 68.79%. But let's look at the fiscal year ending December 2024, an astonishing negative 438.57%. To put that in perspective, this means that for every dollar of revenue Nauticus brought in during that fiscal year, they were actually losing over $4 just on the cost of making their product or delivering their service. This isn't just a bad number, it's catastrophic, and it indicates, by established financial benchmarks, no sustainable competitive advantage, ranking worse than 98.74% of 318 companies in the aerospace and defense industry.
And the situation, unfortunately, doesn't really improve as we go down the income statement. The operating margin percentage for the June 2025 quarter was minus 306.89%. For fiscal year 2024, it was an even more concerning minus 1,279.19%, placing them worse than 97.84% of 324 companies. This means their operational expenses are just completely overwhelming their gross profits, which, remember, are already deeply in the red.
The net margin percentage, the ultimate bottom line, is equally dire. Negative 359.06% for the June 2025 quarter, and a truly staggering negative 7,465.80% for fiscal year 2024.
Minus 7,000%.
Yes. For listeners, that means for every dollar of sales, Nauticus lost over $74. This isn't just inefficient. It's almost unprecedented for a publicly traded company and suggests their entire cost structure is just completely unaligned with their revenue generation. A critical warning sign from the material explicitly states, and I quote, Nauticus Robotics Inc. has never been profitable in the past 3 years. It lost money every year. Furthermore, attempts at fundamental valuation are significantly hampered. The intrinsic value calculated from the discounted earnings model, a standard method, comes out to a deeply negative minus $301.67 per share as of September 10, 2025. But here's the kicker. The model itself flags KITT's predictability rank as not rated. That means the very tool we use to value companies for the long term can't even get a reliable read on Nauticus because its business is simply too unstable to forecast.
The stock's performance reflects this grim picture. A 52-week high of $54.36, representing a minus 93.78% decline from its current price of $3.38, and an abysmal minus 99.90% decline over 3 years. And these weren't just one-off events. They executed a 1-for-9 reverse stock split in September 2025, right after a 1-for-36 split in July 2024. For our listeners, a reverse stock split means they're consolidating shares, effectively trying to boost the stock price, often to avoid delisting. It's frequently a sign of significant financial distress. With an EPS trailing 12 months of minus 237.30 and a net income of minus $110.92 million against sales of only $3.08 million, while the company's financial foundation appears fundamentally unsound, irrespective of any technical achievements.
Okay, I completely grasp the severity of those negative net margins. It's a stark picture. The numbers are undeniably concerning, no question. However, what if we're looking at this through the wrong lens for a company operating in such a nascent, capital-intensive space? These consistently negative margins, especially that gross margin you highlighted, yes, they're a significant concern, but in an emerging deep tech industry like subsea robotics, aren't these often the upfront costs associated with establishing a technological lead and scaling highly complex operations? You mentioned the negative 438% gross margin for fiscal 2024. Isn't a substantial portion of that directly attributable to the very investments in scaling and refining these pioneering technologies? We're talking about companies literally building the future of underwater autonomy, which demands massive upfront R&D and manufacturing scale-up for platforms like Aquanaut and Toolkit. The reported revenue of $2.08 million for June 2025, combined with news of a revenue surge amid strong demand and an excellent start to the 2025 offshore season, suggests that the market for Nauticus's solutions is materializing, even if the unit economics are still being perfected. These expenditures are foundational, I argue, to capturing future market share and critically generating eventual substantial profits. It's truly a long game in this space, perhaps akin to SpaceX in its early days, just burning cash to build that foundational tech.
I appreciate the analogy. I do. But I'm sorry, I just don't buy that these extreme figures are simply growth investment or just foundational costs. Let's be absolutely clear. A gross margin of minus 68.79% for the latest quarter, and that annual minus 438.57% for December 2024 means the company cannot even cover its direct costs of goods sold from its revenue. Forget operating expenses. Forget R&D for a moment. They are losing money on every single dollar of sales before we even factor in overheads. This goes way beyond typical growth investment. This points to a critical structural flaw in their unit economics or perhaps their pricing power. A revenue surge is frankly immaterial if each additional unit of revenue generated contributes to a larger gross loss. The material explicitly concludes that a gross margin of minus 68.79% signifies no sustainable competitive advantage, a direct contradiction to the idea that they are building a defensible market position through technology. You mentioned sophisticated clients, and yes, they have them, but even sophisticated clients won't sustain a company that loses money on every product it sells indefinitely. The company's inability to achieve any profitability in the past 3 years, despite all the strategic moves you've highlighted, strongly suggests a deeper, more pervasive structural issue. It's not just a temporary growing pain. It's a fundamental question of business viability, I think. And that fundamental instability also bleeds directly into our ability to even value this company properly. The inherent unpredictability of Nauticus Robotics' business, right there in its not-rated predictability rank for the discounted earnings model, well, that poses a significant barrier to any reliable long-term investment assessment. We use DCF models to forecast a company's future cash flows, right? But if we can't even rate their business predictability, what are we actually forecasting? It becomes guesswork.
The fact that past EPS, earnings per share without non-recurring items, had a growth rate of negative 21.50%, that just solidifies the difficulty in projecting any future cash flows or earnings reliably. This lack of a stable operating history or any foreseeable earnings stream means that traditional valuation methods offer very little guidance. Any investment here carries an extremely high level of speculative risk. The market simply cannot confidently price a company whose future earnings power cannot be reasonably estimated. It's like trying to hit a moving target in the dark, a deeply uncertain proposition for investors.
That's an interesting point on predictability. And I certainly agree that the not-rated predictability rank is, well, it's a limitation for a standardized model that's looking for consistent historical performance. I get that. But I would frame it differently. This not-rated status, while definitely a red flag for traditional analysts, doesn't inherently negate the company's long-term potential. Many disruptive innovators, particularly in these nascent high-tech sectors, they start with erratic financial performance precisely because they're charting new territory. They haven't yet achieved the scale and predictability that conventional models favor. The true value here, I'd argue, lies in the long-term vision and the successful execution of key milestones that are inherently de-risking the business over time. Think about it. Securing evaluation agreements with global super major oil and gas customers, signing master service agreements with strategic partners. These aren't just symbolic wins. These are tangible steps towards locking in future revenue streams, building a more predictable business bit by bit. The conservative 5% default growth rate used in the DCF model, which is imposed because of their negative historical growth, well, that likely understates the potential for exponential growth if these strategic initiatives truly come to fruition in what is clearly a rapidly expanding subsea autonomy market. You simply can't fit every novel, high-growth potential company into a rigid, traditional valuation box that demands years of predictable profits, can you?
And despite the challenging stock performance, if we look beyond the immediate price action, the insider activities show a mixed but maybe not entirely negative picture.
Okay, yes, some executives did exercise options and sell shares in May 2025 and earlier. But a director, William Flores, notably made purchases in November 2024. That's an insider putting their own cash on the line, right? More significantly, perhaps, consider the presence of major industry players like Transocean and Schlumberger entities as 10% owners. This isn't just a casual investment. It signals, I think, a strategic belief in Nauticus's core technology and its long-term fit within the broader subsea industry landscape. This suggests that sophisticated, informed investors, those with deep industry knowledge and strategic foresight, see underlying value here, maybe even as a strategic component or an eventual acquisition target, even if the public market valuation has been, volatile, to say the least. Furthermore, the regained NASDAQ compliance also demonstrates a clear commitment to long-term operations and maintaining a public presence. That indicates a belief in their own future, doesn't it?
I see why you might interpret the 10% ownership by Transocean and Schlumberger as a strong vote of confidence, external validation. But let me give you a different perspective on that data. Couldn't that also be interpreted as these larger players simply taking an inexpensive, perhaps speculative bet on emerging tech, especially given the rapid decline in KITT's valuation? Has their ownership actually translated into measurable financial stability for Nauticus? Or is it more of a call option for them, where they've made a relatively small investment in a high-risk company hoping for a big payoff if the technology somehow matures? The overall trend of insiders exercising options and then selling shares observed across several executives in May 2025 and earlier. That raises significant questions about their own confidence in the stock's future appreciation. It suggests they're cashing out, not holding for long-term gain. And moreover, the institutional ownership remains quite low at just 4.33% of shares outstanding. That figure certainly doesn't suggest widespread confidence among larger, more diversified investors who typically underpin a stable stock price. The market's reaction, that staggering 99.90% decline over 3 years, the necessity for 2 reverse stock splits within a single year, that speaks volumes about the collective assessment of the company's ability to create shareholder value. Strategic partnerships and even 10% ownership by other companies, while interesting, have simply not translated into a sustainable business or positive market sentiment for KITT itself. The fundamental financial deterioration, I believe, overwhelmingly overshadows any potential strategic value, which at this point has clearly not benefited equity holders.
Okay, as we conclude, I want to bring us back to the broader picture for Nauticus Robotics. It's undeniable they're navigating a challenging financial environment. It's marked by significant investment in a highly innovative and, yes, complex technological domain. However, the company's continuous advancements in autonomous subsea robotics, highlighted by the successful ultra-deepwater testing of its Aquanaut Mark II, and those strategic engagements with industry giants like Shell, Equinor, Petrobras, alongside key acquisitions and alliances, well, these demonstrate a robust commitment to capturing what could be a vital market. While current margins understandably reflect this intense development phase, these strategic foundations suggest, I believe, a clear pathway to future revenue generation and potential long-term value in the rapidly evolving subsea economy. It is a company building the future. And sometimes that comes with substantial upfront costs and a bumpy financial road before profitability emerges.
And while the potential of new technology is always exciting, the extensive financial data for Nauticus Robotics paints, for me, a very clear picture of a company facing severe and systemic profitability issues. We've seen consistently negative, deeply concerning gross, operating, and net margins that significantly underperform its industry peers. The explicit conclusion of no sustainable competitive advantage drawn directly from these figures, coupled with the company's inability to achieve profitability over the past 3 years and its not-rated business predictability for valuation, while it highlights fundamental flaws that these current strategic partnerships have yet to overcome. The market's reaction, vividly reflected in those precipitous stock declines and multiple reverse splits, unequivocally underscores these deep-seated financial challenges. It suggests that operational progress, however impressive it might seem on paper, has simply not translated into a viable or sustainable business for shareholders.